Just before I get started on looking at the post-planning for Frank and Olivier and Janet, I was just listening to what David and Peter had to say about sort of the state of the market in private equity. David talked about $1 trillion of dry capital in the U.S., and it's probably not a bad idea just to maybe take a look at the macro issues that are driving this outcome. So the first observation is in the last 25 years, or maybe even going back as far as 40 years, the number of publicly traded companies in North America has shrunk by 50%. That's 50%. Fewer opportunities to invest in public companies. Now, the total capital in the markets has increased, but maybe not nearly as much as it might have increased had that number of companies not actually been simply acquired by other public companies, or in some cases, gone private. And fewer private companies are choosing the IPO route because they don't have to, as a result of the fact that there's so much money available in the private equity space in the first place. So that's one issue that takes place. The second is that even public companies globally have a surplus of capital. That's one of the reasons why you see so much in the way of share buybacks occurring. So really what they're doing is pushing capital back to shareholders. And those shareholders are struggling because essentially there are not new public companies that they can buy in enough quantity to equal the share buybacks in total. So that money has to go somewhere. And the third factor is that all across the world, the amount of institutional capital, primarily made up of pensions, but you can see this certainly in Canada, has grown by an explosive amount. That money has to be deployed in some place. Now, when you think about the fact traditionally that institutions would look at fixed income as a significant percentage, maybe 40 or 50% of their capital historically, at today's interest rates, where $17 trillion of global sovereign debt is negative, that simply isn't occurring. So they are going to be looking for places, whether it's debt-based or equity-based, that allows them to deploy that capital. So that's part of the issue that's explaining why the amount of capital for private equity, and for that matter, real estate, infrastructure, and other alternative assets has grown as much as it has. The real question, I guess, looking forward, are what are the prospects for that? Well, it depends. If anybody really can predict where interest rates will be in 5 or 10 or 20 years' time, that would be a major factor. But the one observation I will make, and I think it's an interesting thing about demographics, because the irony about looking at the numbers we looked at before, $1.5 trillion of private businesses for sale, the irony of that is a significant amount of money of that $1.5 trillion is going to go back into private equity indirectly through long-term patient capital. So it'll drive itself. And unless you actually think the savings rate or the impact of demographics is going to dramatically change, I'm going to suggest to you that the amount of capital available for any asset class is likely to increase, and that is to say the supply of capital than the demand, the demand will increase faster than the supply. So I think these are all factors that make a difference in the outcomes we're looking at and explain maybe why so many are available. So what I've done here is take a look at this from an external and an internal perspective. So the first example of the planning is, let's assume we have an external sale. So, and when we're looking at Janet, that's her situation. So she's got a holding company, it owns the real estate, it owns the shares in the company, 60%, and passive assets of $2 million. It has paying her a salary of $200,000 a year. Personal assets include her own property, recreational property, RSPs, let's assume around $4 million in total. So her facts that matter to her: she has a large extended family. She has 2 children in the company, but they have no equity or shares in the company this time. 6 grandchildren under the age of 20, close family unit. She's very philanthropic. More than 80% of her net worth is tied up in the company, directly or indirectly. And she has a tax liability. Dave was talking about that, but in her case, the specific number is roughly around $10 million. That's her current status quo. That number is increasing at the rate of roughly 25% for every dollar of increased value. 25 cents of that is going to be taxed in her estate. Now, let's look at this external sale. One of the options she can do right away is establish an IPP for herself. An IPP is essentially a corporate version of an RSP. But in her case, because of her age, her years of service with her own, in this case, company, both the holding company and the operating company over time, she's going to be able to put in roughly $1 million on a tax-deductible basis from her holding company into a pension that effectively acts very similarly to her RSP. She can consider the sale of the building or some or all of the shares of MWT to diversify. This question comes down to whether or not she wants to keep equity inside the company for the benefit of ultimately transferring that to the 2 children she has who are actively working in the company. She can use what's called a donor-advised fund or foundation to minimize the tax and endow her philanthropy. It is possible, with some reasonably effective planning, that between the IPP and a foundation or donor-advised fund, that she can negate all the tax that would otherwise be payable on the sale of the building or the sale of the shares. So it all depends on the facts of the situation as to how these can be used. She can freeze shares in the holdco and arrange insurance to reduce tax in her estate almost immediately from $10 million to $6 million. So just by doing some proper will and estate planning today, she can make sure that the tax liability is not the size it was, and then she can make sure that from that point forward, it actually starts to shrink. She can reconsider the reorganizing the shares in holdco in MWT to allow the children to be active shareholders. So that comes down to whether or not, as a result of an external sale, the external buyer wants to have the existing management, including the kids, as part of the solution. Maybe not likely in the case of a strategic buyer or even a majority buyer such as a PE firm, but in terms of a minority PE buyer, in fact, they would almost insist that they knew that there was that ongoing management. So that may be the hybrid solution on the external side. And finally, she's going to be in a position to lend funds to a trust if she wants to and earn income in that trust that could be income split with her children and her grandchildren, which might be important, especially related to the children who are not actively involved in the company. So when we take a look at Frank's situation, well, Frank actually, being the operations manager, he bought the shares ago. We know all of these other facts. The shares are 75% of his net worth. So his action steps. He can also do an IPP as part of his retirement. The reason that's attractive to him, it doesn't have to be funded right away. He's willing to wait 3 years to retire. It can be funded over 3 years. When the money comes out of his IPP, it's automatically income split with his spouse. So even though it is relatively more difficult to income split with a spouse, this is a very easy way to accomplish that. Same issue that applies with his RSP funds as well. He can sell the shares for $5 million and take vendor take back for 3 years. In other words, that would allow him to amortize his capital gains tax. In fact, he could take a vendor take back note for 5 years and spread it over an even longer period of time and amortize the tax that would be payable. Is this going to be taxed as a dividend or a capital gain? As Dave spoke to, that very much depends on the structure and the nature of the transaction itself. He might be able to claim this small business capital gains exemption, and as Dave said, that may require a structure called a sidecar to make that work. If he does all of these things as well as possible, his total tax bill might be $1 million, and then he can use any net proceeds to income split as well, depending on the current prescribed rate that's in effect at the time. Total tax, 17% of the $6 million received. The person that's going to have the biggest problem with an external buyer is Olivier. If you remember, age 47, bought the shares in 2011, looking for growth, but has the conflict of wanting capital out of the company for education and recreational property. So that's not without some challenges. So let's say he reduces his position by 5% because of this external buyer coming into play and gets $1.5 million coming out. After the capital gains exemption, assuming we have a third-party external buyer, he's got $1.3 million. He pays off the mortgage, which generates $20,000 a year of cash flow. There's $1 million for the recreational property, so he's got 2 of his objectives met, funding for education and the recreational property. But what he's done is he's gone from 20% to 15%, and presumably the new buyer wants this person to stay to cause the company to grow. So he's actually gone the wrong way from an equity perspective. One way to reverse that is to consider negotiating with the new owner options in the company that are dependent on certain financial outcomes or growth in the company. Those options, if they're issued at what we call the money, at the current value of the company, are not taxable. If they grow over time because the company's share value grows over time, they're still not taxable if and when he exercises them for shares. They're only going to be taxable if and when he sells those shares. So this is a way for him to go from 15% back to 20 or 25 or even 30%, depending on how that transaction is put together. So let's look at the internal solution that could occur. So this is the assumption. They don't want to sell to an outside buyer. They want to continue the company in some way, but people do have to practically know how to transition themselves out of the company. So in Janet's case, she freezes her interest in the holdco and issues to the two children directly, the ones active in the company, new common shares representing the growth that would have otherwise accrued to her holding company. She sells the building. She uses the IPP and the donor advised fund, as we discussed before, to minimize tax. She invests the balance of her proceeds from the sale of the building, and she can keep it in real estate if she wants, but she can be in a balanced portfolio, and interestingly, she will get the same income on that residue that she's getting now in the building. One of the things to understand about, because so many of our clients love the idea of owning the real estate that's behind the business they're in. They like the return. They say, you know, I'm a safe tenant. Where's the risk? Well, let's just think about that for a second. This business is selling at 6 times earnings. Another way of looking at it is a return on invested capital in this building for an owner at 6 times is 16.7% per year. That's the return. So that's, if I put in $1 million, I'm going to earn $167,000 of pre-tax income. That's the point of that number being a 6 times multiple. The building is generating $500,000 a year of income on a $15 million value, which is less than a 4% cash-on-cash income. It's 1/4 the cash income return of the business itself. To make it more complicated, because in fact 100% of the rent comes from one tenant, and that tenant happens to be the firm that I own, I've compounded the risk of actually owning the building. I'm far better off to have a lease with a third-party owner and have the same amount of capital deployed in real estate that's got nothing to do with the business I own. Then I am financially independent from the actual business I run. If I want to have selling power, that's real selling power. Having it all tied together actually limits the outcomes I can create. And then ultimately, those shares would be redeemed over 10 years. If we look at Frank's situation, he is going out one way or the other. So really, we're looking at a similar transaction that we looked at before. One of the things, of course, is if the company is doing this internal financing, unless we go and get external debt financing, this company is not likely paying out any dividends for many, many years under this scenario, which is maybe perfectly fine, but they have to recognize this. Now let's look at Olivier's situation. Once Frank's shares are redeemed, basically Olivier is now 25% ownership. He gets options to increase to 33% over 5 years, and at the same time, as Janet's preferred shares are being redeemed, her 2 children are also moving up to a 33% equity position for their common shares. Eventually, the 3 of them will be equal shareholders, although the children, by definition, will still have control of the company. But what they're doing is, what Janet's doing here with this internal solution is she's saying, I want an experienced CEO to help generate the transition of the company to G2. Within 15 or 20 years, Olivier himself will want to retire, and they will be in control of the company and more than capable of running it. At least that's the model. So why plan? Well, basically, the planning is a dry run, or it's a rehearsal or a practice. So the purpose of the exercise we've done today is to say it's a lot better to actually go through this exercise even if you have no immediate intention of selling or exiting at all. So the benefits include less stress, less tax, more security, and better results. So with that, I think we've finished our formal remarks. What we'd like to do is get everybody to take a little bit of a leg stretch and then come back to your pause, and we're going to circulate and talk not just about this case study, but about your own situations. And then the four of us will regroup up here at 10:30 and go through a Q&A for you. So let's take a break, and thanks very much.